Hello, did you know that one small mistake with your solo 401k rollover could cost you thousands in taxes and penalties? Today, we are going to break down the 60-day rule, a rule every self-employed professional and IRA participant needs to understand before moving retirement money, whether moving an IRA to a solo 401k or vice versa, or even moving a former employer 401k to an IRA or a solo 401k. In this webinar, I'll share how a properly executed rollover could help you maximize tax savings and keep your retirement money growing without the stress of IRS penalties. Today's topic is, what is the 60-day rule for solo 401k? As always, please go ahead and type over your questions during today's daily webinar. It doesn't have to be specific to today's topic, which is, what is the 60-day rule for a solo 401k? It can be questions surrounding any aspects of solo 401k plans, full-time employer 401k plans, rollover startup 401k, and even self-directed IRAs. We are well versed in all those regulations. Please also like today's video and also subscribe to our channel so that you receive notifications of when we go live. We typically go live at least once a day, oftentimes 2 times a day. Today we'll be going live again here in a few hours. So if you don't get a chance to ask your questions during this session and you subscribe to our channel, you can receive a notification of when we'll go live again here in a few hours. You can also visit our YouTube channel, which contains a large video catalog, over 900 videos covering all aspects of solo 401k plans. You can also visit our community where you can join. There's no charge to join. You can post your comments on the forums. You can also post blogs, especially if you're a financial advisor or a tax professional or any type of professional for that matter. You can post guest blogs and even link back to your page so that you get some traffic to your page. And we have over 33,000 members on that community. We have a lot of advisors and CPAs and attorneys who have posted guest blog posts, and they've seen a large increase of traffic to their website as a result. You can also visit our solo401k.ai artificial intelligence. The address there is solo401k.ai. So take a look at that. And again, go ahead and type over your questions during today's webinar, and we'll go ahead and pause and answer those questions as they come in. In the meantime, the 60-day rule and why it matters. Well, one mistake can cost you a lot of taxes and penalties. That's one reason why it matters. That's probably the only reason you need to know. You also need to understand the rules for solo 401k rollovers and what every self-employed individual that wants to open a solo 401k needs to understand. So here is what we are going to cover today. What the IRS 60-day rule means. So what is a 60-day rollover rule? Well, there are various ways to move funds from an IRA to a solo 401k plan, for example. One way to do that is by processing a 60-day rollover. The 60-day rollover means that you receive a check payable in your name. So let's say you have an IRA with an IRA custodian such as Charles Schwab, and you ask Charles Schwab to make a check payable in your name. Let's say your name is Larry Bird. So Larry Bird receives a check from his IRA in the amount of $50,000 from his IRA at Charles Schwab. So that check is made payable in Larry Bird's name. Well, Larry Bird then deposits that check into his personal bank account because he's planning to use those funds for a short-term period for some personal use, but he later wants to move those funds to a solo 401k plan, for example, because Larry Bird is self-employed. So he opens a solo 401k. So again, that check was made payable in the name of Larry Bird. So it was not made payable in the name of the solo 401k, but rather in the name of Larry Bird. So Larry Bird turns around and deposits that $50 check made payable in his name into his personal bank account. That means that Larry Bird now has 60 days to deposit those funds to the solo 401k or even to that same IRA or another IRA. If Larry Bird does not deposit those funds that he distributed from that IRA at Schwab within 60 days to his solo 401k or to an IRA, then he's going to have to pay taxes on that rollover because that check was made payable just in Larry Bird's name and he deposited those funds into his personal bank account. That 60-day time window or time period starts when Larry Bird took constructive receipt of that $50,000 rollover check. So it's not when Schwab sent the check, but rather when Larry Bird received the check in the mail. That's when the 60-day rollover period starts. Now, in some instances, the client may ask Schwab to instead wire the money from his IRA directly to his personal bank account. Therefore, as soon as that wire hits Larry Bird's personal bank account, that 60-day window starts, which means he's going to have to roll over those funds to a solo 401k if he's self-employed, or to that same IRA or to another IRA within that 60-day period. So that's what the 60-day rollover means with regards to moving money. Now, let's talk about the direct rollover rules. Give me a moment here and we'll compare the direct rollover versus the 60-day rollover period. And we'll come back and talk about the risks of missing the 60-day deadline. Give me a moment here. Okay, so let me pull up that slide here. Let me share my screen for this particular comparison here. We're going to compare a direct rollover versus the 60-day rollover. They're vastly different. Give me a moment while I pull up that particular screen here. Okay. Hopefully you can. So let's compare a direct rollover versus a rollover. Because there's a difference, and unfortunately in the industry, a lot of professionals use the word rollover incorrectly, as opposed to calling it a direct rollover. So a rollover, which we just discussed, is when the rollover check is made payable just in your personal name. We use Larry Bird as an example. And then you deposit those funds into your personal bank account. That's a rollover, because you have 60 days to then roll over those funds that you deposited into your personal bank account from the IRA. You have 60 days to then deposit those funds to an IRA or to a solo 401k plan. When you process a 60-day rollover, and if you're trying to move it from one IRA to another, you can only process one of those per 12 months. So it's not per year, but rather 12 months. So for example, let's say that Larry Bird processes a 60-day rollover in September. That means that rollover clock starts in September. Let's say he performed that 60-day rollover on September 1st. So that 60-day rollover window obviously starts as soon as he receives that check in the mail. Same thing with the 12-month period. As soon as he receives that check in the mail, that once per 12-month rollover window starts. So September through September of next year. So he's not going to be able to process any more rollovers from an IRA to another IRA. And you have to aggregate all your IRAs. It's not on a per IRA basis. It used to be, the thinking used to be that it was on that 60-day rollover rule applied separately to each IRA. Well, there was a famous court case about 10 years ago that put an end to that. There was a CPA that got a little crafty. He had many IRAs, and he was essentially churning the 60-day IRA rollover rule by processing a one per 12-month IRA rollover from each IRA separately. Well, the IRS ruled in the tax court case that was disallowed. They viewed that as abusive. So again, when you're determining the 12-month period with regards to how many times you can process a rollover from an IRA each year, you have to aggregate all your IRAs, including your SEP IRAs and simple IRAs. So you might have a Roth IRA, a traditional IRA, a simple IRA, or a SEP IRA, and you may process a 60-day rollover from any of those IRAs. You won't be able to do it from any of the other IRAs for a 12-month period. So it's aggregated between all your IRAs. Now, what's interesting here, and a lot of people are not aware of this, is that the 60-day IRA rollover period, that 12-month period only applies if you're moving money from one IRA to another via the 60-day rollover period. It does not apply if you're moving that IRA via 60-day rollover to a solo 401k or a full-time employer 401k. You might be scratching your head. Well, let's dissect that further. Let me see if I can share my slide on that. Give me a moment here. So let's take a look at this slide here to illustrate what I just stated there. So again, we're talking about the limit in the number of rollovers, 60-day rollovers that you can perform from an IRA. We already talked about how it can only be done once per 12-month period if you're moving from an IRA to another IRA via the 60-day rollover window. Again, don't confuse the direct rollover with a rollover. A direct rollover is where the funds are directly rolled over to an IRA. A rollover is where you receive a check payable in your personal name and the funds are deposited into your personal bank account, or you have funds wired from your IRA directly to your personal bank account. That's referred to as a rollover. That's not, if we're talking about a direct rollover, or more specifically, a trusted to trustee transfer, where you're moving the funds from one IRA to another directly. So the funds get deposited directly from one IRA to the other and never makes a pit stop into your personal bank account. That's referred to as a trusted to trustee transfer, so one IRA to another, or a direct rollover from one IRA to another. Now let's talk about what I was mentioning earlier. The 12-month period. Again, that 12-month period does not apply when you're moving money from an IRA to a solo 401k via that 60-day rollover period, where you receive a check payable in your name, you deposit that check into your personal bank account, and then you turn around and deposit those funds within 60 days from your personal bank account to the solo 401k. There's no limit on the number of those that you can perform. Yes, you heard that right. It's one of those quirky IRS regulations that most financial professionals out there, or even CPAs and tax advisors, are not aware of. So let's give an example of that. Let's use Larry Bird again. Let's say Larry Bird has Schwab process a rollover check of $25,000. Let's say he does that in September, of $25,000, where the check is made payable in the name of Larry Bird. Larry Bird then deposits that check into his personal bank account. Larry Bird has 60 days from the date that he received that check to turn around and deposit that check that he deposited to his personal bank account to the solo 401k. So he would have a check made payable from his personal bank account to the solo 401k, and he would deposit that directly into the solo 401k bank account within 60 days. He can also have the funds wired directly from his personal bank account to the solo 401k as well, as long as he does that within 60 days. Let's say Larry Bird turns around and does that again 2 weeks later or the following month. He can do that again without violating that 1 per 12-month rollover rule, because he is going to turn around and deposit those funds from his personal bank account to the solo 401k within 60 days. That only applies if you're doing that to a solo 401k or a 401k. It does not apply if you're doing it to an IRA or the same IRA. If it's going from an IRA to another IRA via the 60-day rollover rule, you can only do that once per 12-month period, each 12-month period. And again, you have to aggregate all of your IRAs when determining that 12-month window. So hopefully you get some time to digest that. You can come back and listen to this webinar to understand that further. Okay, let's keep talking about the direct rollover, what a direct rollover is compared to a 60-day rollover. Let me go back and share my screen on that. One moment here. So we've been talking at great length regarding the 60-day rollover. Let's talk about a direct rollover. So a direct rollover is different. Again, that's where the check is made payable in the name of your solo 401k plan from the IRA, and then you deposit that check directly into your solo 401k account. There's no 60-day rollover period that applies there. Therefore, you can do as many of those as you want as well, without triggering any adverse reporting. Same thing with an IRA. If you're moving an IRA to another IRA directly, you can do an unlimited amount of direct rollovers. That's where the check is made payable from one IRA directly to the other IRA custodian. So the funds get deposited directly to the other IRA. It never makes a pit stop into your personal bank account. So that's the difference between a rollover a 60-day rollover versus a direct rollover. Now, with regards to reporting, when you move an IRA via the 60-day rollover period, uh, the IRA custodian that the funds were rolled over from via that 60-day rollover, they're going to issue a Form 1099-R to report that 60-day rollover distribution. They'll report it as a distribution. So when you receive that Form 1099-R and you look at box 7 of that Form 1099-R, there's going to be a code 7 if you're over age 59 and a half, or a code 1 if you're under age 59 and a half. That tells the IRS that you distributed the funds from the IRA to your personal bank account. So now the onus is going to be on you to make sure that A, you deposit those funds within 60 days to that same IRA, another IRA, or to the solo 401k. And then second, you're going to have to report that 60-day rollover as not being taxable on your Form 1040. There's a line number on your Form 1040, I don't remember the line number, where you're going to have to list that amount that you rolled over within 60 days from that IRA. You're going to have to list that in line A, and then in line B, you're going to have to type in 0 as the taxable amount, and you're going to have to type in the words rollover within 60 days. That's how the IRS is going to know that it was processed as a non-taxable 60-day IRA rollover. So it's not as clean. Now, if you do it as a direct rollover or a trusted to trustee transfer where the check is made payable in the name of your solo 401k, for example, and then you deposit that check directly to the solo 401k bank account or brokerage account. So now your personal bank account, but rather the solo 401k brokerage account or bank account, then that's going to be a direct rollover. So the IRA custodian that released those funds, they're going to use a different code in box 7 of that Form 1099-R. Instead of using a code 1 or a code 7, they're going to use a code G. A code G tells the IRS that these funds from the IRA were directly transferred from the IRA to a solo 401k or to an IRA as a non-taxable direct rollover or trusted to trustee transfer. And you can do an unlimited amount of those as well. And that's the preferred method if you're trying to move funds from an IRA to another IRA or to a solo 401k. Now, some clients like to use that 60-day rollover period from an IRA because they're effectively getting a 60-day loan from their IRA. So they can use those funds for 60 days and then turn around and get those funds back to that IRA or transfer them to a solo 401k if they're self-employed within 60 days. So they call that oftentimes in the IRA industry a short-term IRA loan. Don't confuse that with the solo 401k participant loan, because a solo 401k or a 401k allows you to borrow from that plan an amount of $50,000, a maximum amount, and you can borrow over a 5-year period or longer if you use the proceeds towards the purchase of your primary residence. You cannot borrow from an IRA, but an indirect way of borrowing from an IRA is by utilizing that 60-day rollover period, which again, it's only a 60-day window because you have to make sure you roll over those funds to the solo 401k or the IRA within that 60-day window. Okay, again, go ahead and type over your questions during today's webinar, and we'll go ahead and answer those as they come in. So we just discussed the difference between a rollover and a direct rollover. Let's take a look at some more information here. We also talked about the risks of missing the 60-day deadline. Essentially, if you miss that 60-day rollover deadline, that means you're going to have to pay taxes on that rollover amount. So it's going to be treated as a distribution for the year. So now you're going to have to pay federal taxes, possibly state taxes, depending on your state of residence, as well as a 10% penalty if you're under age 59 and a half. So the penalties can be dire. We talked about strategies to avoid the mistakes. We talked about processing a direct rollover instead of a 60-day rollover. As far as how to fix errors if mistakes happen, that deals more with if you requested the IRA custodian to process the transaction as a direct rollover instead of a 60-day rollover, and the IRA custodian is not cooperating and issuing a corrected Form 1099-R. Under that instance, you can seek relief from you did process that rollover timely and correctly, but the IRA custodian reported it incorrectly. You can provide the IRS backup documentation to support that, and the IRS will often waive any penalties due to the 60-day rollover mistake if it was caused by the IRA custodian, for example, or if you had some type of health issue, things of that nature. Okay, let's see if we can look at some more slides here. So again, if you're doing a 60-day rollover, whether it's going to an IRA or a solo 401k, you need to do that within 60 days from the date that you took constructed receipt of those funds in your personal bank account or you received a check. We talked about how if you miss that 60-day rollover deadline, it's going to be treated as a taxable distribution. And it may trigger taxes as well as the 10% early distribution penalty if you're under age 59 and a half. Some smart strategies, we've already touched on this. It's to process a direct rollover instead of a 60-day rollover. We talked about how a direct rollover means that the check is made payable in the name of the solo 401k and it gets deposited directly to that solo 401k from that IRA. Or you have the funds wired directly from that IRA directly to the solo 401k bank account or holding account. And more importantly, the IRA custodian processes and reports that as a non-taxable direct rollover on Form 1099-R using code G and box 7 instead of using code 1 or 7. So you want to try to deposit those funds quickly. And you want to keep records, which keeping records is pretty straightforward. You'll have the IRA account statement, you'll have your personal bank account statement, and you'll have the solo 401k bank account statement to show the flow of the funds. Again, you can request waivers if you miss that 60-day rollover due to circumstances beyond your control. You can request a waiver from the government, the IRS, the Department of the Treasury. So some key takeaways, make sure you understand the 60-day IRA rollover before you move funds from an IRA. Direct rollovers are safer and simpler. Mistakes can be costly, but fixable with the right strategy. Use the rules wisely to protect your retirement savings. Here at my solo 401k Financial, we've been assisting clients move funds from their IRAs and former employer plans for over 15 years. So we are well versed on these regulations. And as part of the solo 401k opening process, we'll assist clients in moving funds from their IRA or former employer plan by completing the applicable transfer forms that the IRA provider or the former employer will provide. If those institutions will not provide transfer forms, we'll make sure to draft those for you so that those funds get transferred as a non-taxable trusted to trustee transfer or direct rollover to the solo 401k. So here in my solo 401k Financial, we always recommend moving funds via direct rollover or trusted to trustee transfer, not via the 60-day rollover strategy. It's much safer to do it via direct rollover or a trusted to trustee transfer. We went over this slide earlier where we talked about how if you move funds from an IRA by a 60-day rollover period, you can only do one of those per 12-month period if you move it from one IRA to another. If you're moving it to the solo 401k, however, that 12-month rule does not apply. You can do an unlimited amount of 60-day rollovers from an IRA to a solo 401k, just like you can do an unlimited amount of direct rollovers from an IRA to a solo 401k plan. Let's see here if we have any other. I don't see any questions right now during the live chat. So we're about to the end of our webinar here regarding today's topic, which is what is the 60-day rule for a solo 401k plan? Now let's talk about moving funds from a solo 401k to an IRA. So you can move funds from a solo 401k to an IRA by a direct rollover or a 60-day rollover as well, just like you can move funds from an IRA to a solo 401k or an IRA via the 60-day rollover period. So if you do a 60-day rollover from your solo 401k, you first have to meet a triggering event. You generally cannot move funds out of a solo 401k unless you're age 59 and a half or no longer self-employed. If you do that by a 60-day rollover period, that means the check is made payable in your personal name. You then deposit those funds into your personal bank account, and then you have 60 days to roll over those funds to an IRA or back to the solo 401k plan. That's what's referred to as a 60-day rollover. A direct rollover is where you move the funds from the solo 401k to an IRA, but instead of depositing the funds to your personal bank account, the check is made payable in the name of your IRA custodian, and the funds are deposited directly to that IRA, or the funds are wired from the solo 401k directly to that IRA custodian. You can do an unlimited amount of direct rollovers, but again, if you're moving it from a solo 401k to an IRA, you have to meet those triggering events. Age 59 and a half or no longer self-employed. Okay, we've come to the end of our webinar. Thank you for joining today's session. We'll be back live again here in a few hours. Please like today's video. Please subscribe to our channel to help get the word out to other solopreneurs like yourself. Until next time, have a great day.